The following program is paid for by Lifespan Wealth Management, providing financial advice since 1993. At Lifespan Wealth Management, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, contact their office at 478-922-8100 to set up your complimentary consultation. Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience, and you can learn more about them by visiting their website at retirerelax.com. While you're on the site, visit the special report section, which provides great financial education information on many different topics. You can also sign up to receive their digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money. They also offer seminars to the community at no cost. If you're looking for a guest speaker for your church or civic organization, give them a call to discuss the topics you would like them to cover. Again, their contact number is 478-922-8100. Now, from the Macon studio of News Talk 940 WMAC, it's time for Your Money with Sherry Goss, Randy Goss, Jonathan Eisner, and Corey Albrecht.
Good morning, everybody. It's
Good
great
morning.
to be back with you.
Good morning.
I hope y'all had a very wonderful holiday. I know we did. So it's great to be back with everyone. And
we're without Sherry today
We
because
are.
she's had a minor procedure, so she's
minor
resting
procedure.
up.
Yep, nothing serious.
So it'll be just the gentleman on the show today.
We hope we do her well. So guys, what was your number one resolution for 2026?
Corey, I'm going to let you go first because yours is a lot more exciting than mine.
I don't know if it's maybe exciting for other people.
You actually have one.
Yes,
so
I guess that's true. My New Year's resolution was actually to cut out unnecessary sugar from my diet. Unnecessary being anything that could be added or snacked on. That being no soda, no sauces, no sugary snacks,
Wait a
no
minute.
sweets.
In your house, that's going to be extremely difficult.
it
Your
has
mom
been-
can cook.
Italian mama likes
Your
to
mama
cook.
can cook.
Exactly. And it has been just salt and pepper. That's all I've had on everything. So, and people always say, "Oh, I feel so
there's
much
more
better."
there's more spices than salt and pepper, right?
We're working on it.
Okay.
We're working on
All
it.
right.
All right, is that it for you?
Yeah.
All right, so here's how exciting mine is. I don't have one. I've never been a goal-oriented person. I'm not proud of that necessarily, but my personality type is that when I want to accomplish something, that takes front and center. And I'll do whatever needs to be done to make it happen, and probably to a fault, because other things, which might also be pretty important or maybe even more important, they get pushed to the side. But that said, it's a new year, and I've mentioned it before, but funding our retirement accounts is a very high priority for me and for Katie. And I've got a little bit of debt to work that I'm working on paying off in the near term. But as soon as that's done, focus is going to be funding retirement accounts for the whole year as soon as we possibly can. Big priority.
That's good. Well, mine is spending more time with the granddaughter. And one here at our office is to continue what we started just about a month and a half ago. And we are the guys in the office started a routine of doing at least 100 push-ups a day. And we have been doing pretty good with
awesome.
that. It's
Yeah.
been great. But did you guys know that the average resolution lasts less than 4 months? And that's according to a poll conducted by Forbes. And only 1% of the people reported to stick with their resolutions for the entire year. So we do wish you all the best on whatever your goals are. But remember this. Don't make the goals too big and vague to begin with. Start small and have a consistent steps that compound with time.
Yep, that's good advice because those steps may not feel dramatic now, but they do add up, just like investing.
That's right. All right. The IRS rolls out rules for deducting car loan interest under the new tax law, and here's what you need to know. To qualify for the deduction, passenger vehicle is defined as a car, a minivan, a van, a truck, or SUV, or a motorcycle with a gross vehicle weight of less than 14,000 pounds, and that has undergone final assembly in the United States. And it has a VIN that starts with a 1, 4, or a 5, and that typically indicates the vehicle was made in the United States to qualify for the deduction. The interest must be paid on a loan that originates after December 31st, 2024. This tax credit does not apply to a used vehicle, only new vehicles, and the deduction applies to interest paid on the loan for personal use vehicles, not for vehicles used for business or commercial use. You can deduct interest up to $10,000, and that's the cap. Keep in mind that this is a deduction for interest paid, not the total car payment.
So when I first read this earlier this week, you can imagine I didn't get to the used car. I mean, that this doesn't apply to used cars, and I got real excited.
I bet you
because
did.
you guys know how many cars I bought in the since December of 2024, right?
Not because you're a car addict. It's
No.
because of accidents.
Because of accidents for my son. He's on his third car. I bought my wife a new car to us. It's used. I bought myself a new car to me, but it's used. So I can't take advantage of any of these. But man, I got real excited before I got to that used car part
It's like,
that it doesn't apply
just
to
let
used
the
cars.
air right out of that balloon.
Yes.
All right. Next up is Saudi Arabia to open financial markets to all foreign investors next month they've eased the rules to attract more money from abroad. The amendment approved by the Capital Markets Authority eliminate the concept of the qualified foreign investor, scrapping the rule that allowed only international investors with direct consent access to the Saudi capital market. The move will allow investors from around the world to invest directly in the capital markets, the CMA said in a statement, adding it would support inflow to improve market liquidity. Saudi Arabia, which is more than halfway through an economic plan to reduce its dependence on oil, has been trying to attract foreign investors. They're doing this by establishing exchange-traded funds with Asian partners in Japan and Hong Kong. Last year, regulators opened the door for foreigners to buy listed firms that own real estate in Mecca and Medina without changing restrictions on direct land ownership. That's a big step for them.
Yeah, it is.
Agreed.
Next, back to the U.S., residents in 9 states will pay lower income tax rates in 2026. Happy New Year indeed. Marginal rate cuts on the next income dollar increase the incentive to work and for more people to remain in that state. States that are cutting taxes are Ohio, Georgia, Indiana, Kentucky, Mississippi, Montana, Nebraska, North Carolina, and Oklahoma. Between 2021 and 2025, 8 states switched to a flat tax, including Arizona, Iowa, Mississippi, Georgia, and Louisiana. In 2026, companies in Georgia and Nebraska will also pay a lower corporate tax rate, which attracts new business.
Yep, and this from The Economist. This is a quote. I think 2026 can be a very good year. A cheerful forecast from Scott Bessent, America's Treasury Secretary, who expects the calendar's turn to herald faster economic growth. His optimism has foundation. The effects of the One Big Beautiful Bill Act, or the BBB, a tax-cutting law enacted this past July, will soon start to be felt. Americans will receive refunds that reflect retroactive tax cuts on income from 2025. They'll also find that levies on monthly earnings have fallen. According to Piper Sandler, an investment bank, these 2 years of tax cuts in one are worth about $191 billion. Such tax cutting should be enough to boost GDP by about 0.3%, a reasonable stimulus given the economy probably grew by 1.9% in 2025. And it's just one of several factors that could prove Mr. Bessent right. The consensus among economists surveyed by the Federal Reserve Bank of Philadelphia in November was that growth would slow to 1.8% in 2026 as haphazard policymaking and tariffs weighed on the economy. Could their gloom be proved misplaced? Well, we shall see. America grew at a healthy annualized pace of 4.3% in the third quarter of 2025, according to data released on December 23rd. Yet a record 43-day shutdown of the federal government in October and November will have slowed the economy to a far slower pace over the subsequent months. In the new year, barring another shutdown, government spending should return in full force. This could provide an impulse to growth worth 0.6% of GDP on top of the tax refunds.
At the same time, the administration has weakened tax enforcement. If rule of thumb from past research are used, the effect could be worth an additional 0.25% of GDP, if not more. In theory, tariffs should prevent acceleration. If duties were to stay constant, they would raise about $215 billion in 2026, according to the Congressional Budget Office, up from $114 billion in 2025. Such levies do not directly hit consumers, but they are passed through on higher prices. They erode shoppers' purchasing power over time. Because of tariff revenue, both the IMF and the OECD forecast that America's primary budget deficit, which excludes interest payments, will shrink in 2026, a fiscal contraction rather than a stimulus.
Yet these forecasts do not account for the probable fate of about half the tariffs at the Supreme Court. In a case for which a judgment could come at any moment, the court is likely to rule that levies imposed under the International Emergency Economic Powers Act are unlawful. That would have two consequences. The first is another set of refunds, this time to companies that paid unlawful tariffs in 2025, which could be worth about 0.5% of GDP. The second is to disrupt tariff revenue in 2026. Although the administration will be able to rely on other authorities to plug a lot of the gaps, it will be challenging to raise as much tariff revenue, since many of the alternatives are cumbersome. As such, the strike down of tariffs could make the overall stance of the budget stimulative.
And that means America might enter 2026 with both monetary and fiscal cannons firing. On December 10th, the Federal Reserve cut interest rates to 3.5 to 3.75, and that's the lowest since 2022. As recently as September of 2024, rates were 1.75% percentage points higher. The subsequent loosening is still working its way through the economy, and more cuts are likely in 2026. President Trump will name someone to replace Jerome Powell as the Fed chairman in May. In January, the Supreme Court will hear a case pitting Trump against Lisa Cook, a governor he is trying to sack. If the court sides with the president, a seat will open up. Another will be available if Powell also vacates his position on the board, which otherwise runs until 2028. Although Trump remains unlikely to capture the Fed completely, he will probably be able to tilt the central bank towards a looser policy. That would lower the risk of a stock market crash. The most obvious threat to the economy. Although warnings of an artificial intelligence bubble are everywhere and some AI-related stocks have tumbled, the consensus on Wall Street is that the S&P 500 index of stocks will raise by about 9% in 2026. Should that come to pass, it would support household wealth and therefore consumer spending. It would also probably mean that the AI investment boom will be sustained. Capital spending of all sorts has received more favorable tax treatment since the One Big Beautiful Bill has passed.
For all these reasons, a vocal minority of analysts say that 2026 will be a year of strong economic growth. Some expect it to be an international story. Fiscal expansion in Germany and consumption-boosting reforms in China are factors that will contribute. Japan, too, is likely to see stimulus, which could come to about 0.4% of GDP under its new government. Lower oil prices will provide a further boost. A barrel of Brent crude now costs about $61, near a 4-year low, largely owed to healthy supply. Labor markets are a dark spot, more because of a low hiring, other than layoffs. Sentiment will pick up next year and support both solid GDP and job growth, argue economists at J.P. Morgan Chase.
At the Fed's meeting in December, the median rate setter predicted American growth of 2.3%. Would such an acceleration be sustainable? Inflation remains too high, and the public is angry about prices. Strong wage growth suggests that the labor market is not too soft, despite low hiring. That makes it an odd time for a combined fiscal monetary stimulus, which might reignite worries about the government's indebtedness. President Trump's picks for the Fed could erode the credibility of its 2% inflation target, which could in turn lead to a risk premium emerging on Treasury bonds. Higher long-term interest rates would raise the cost of capital and undo the benefits of fiscal loosening. Yet, in recent years, the global economy has shrugged off dour predictions about the impact of snarled supply chains, high interest rates, the Russian-Ukraine war, and, to a degree, tariffs. There's currently no big shock for it to survive and plenty of scope for it to outperform. Mr. Bessent has reason for New Year cheer. Very, very positive, and I hope this is correct.
On to our weekly scam alert, Microsoft Defender scam. Something to watch out for when you're online. You may get a pop-up that looks like a Windows or a Microsoft pop-up telling you something is wrong with your computer. The logo will be right, and often it will say that Microsoft has stopped working or it has detected a virus, and you need to call the number listed immediately to get it sorted out. Microsoft and Windows have the ability to fix the issue with your computer from where you're sitting. There is no reason that you would need to call them to fix that problem. This is almost always a scam, and you can easily search for Microsoft's number to see that that number that they gave you does not match their helpline.
That's right.
All right. Too many people forgot their RMDs last year. Don't make this billion-dollar mistake. One of the more obscure certainties in life is that once you hit the age for required minimum distributions, which currently is 73, that you have to take them from your accounts that have pre-tax money. So our support staff, Kathy and Tia, they run a report each year to see who has to start taking these distributions. And they call our clients, they set up bank information, set a date in the system, and the distributions go out. Some people want to use the money, some people want to donate the money, and some don't want to take it at all. So we roll it into another investment account after it has been taken. Our systems automatically tell us how much our clients' required minimum distributions are, and we follow this very closely to make sure that all of our clients get these distributions every year. So it was shocking to read that about 7% of Vanguard customers missed the deadline in 2024, and this group paid an average of $1,100 in penalties. Vanguard has 400,000 people in its RMD population, and it estimates that the overall U.S. population of RMD age is about 8.7 million people. That puts the aggregate amount of fees for missed withdrawals in the neighborhood of $1.7 billion.
Most of the Vanguard violators missed their payments completely, and more than half of them missed in multiple years. Another 24% of clients took too small a withdrawal in 2024, which also leads to problems with the IRS. The current penalty is 25% or 10% if it's fixed immediately. Only about 70% of Vanguard RMD population got things right last year. Vanguard's analyst points towards investor knowledge as the culprit in most cases of missed RMDs. The firm did not see a strong age pattern that would suggest cognitive decline as people age to be a major factor. A much stronger predictor was if the person missed their withdrawals 1 year. Those people were more likely to miss it the next year too.
A retirement account custodian like Vanguard sends messages to clients, provides educational materials on its portal, and makes things easy with automated withdrawal systems. But it can only lead its clients to the information. It can't make them follow through. Vanguard said about a third of its RMD customers use automated withdrawals features. The same goes for tax professionals and financial advisors. The IRS places the onus on the responsibility of the taxpayer. They are the ones who have to make sure that this task gets done every year once they reach the age when RMDs are required. A CPA added to this story. He recently had to help a client whose father had died last year before having taken his RMD. The child had no idea that they had to take the RMD for him and then continued taking the RMDs on the account that they had inherited. It required immediately paying the money that was due, filing the correct tax forms to fix the mistake, and asking for forgiveness for the penalties. So this could be a very important thing to talk about with your family. Ask them to call their custodian and set this thing up to be done automatically each year. That's what we do, and the system updates the amount each year so that the correct amount goes out. The problem is much bigger than I would have ever imagined. This is why I like our business model. We work with one of the largest broker-dealers in the United States, which is Osaic Wealth, but they allow us to operate like an independent firm, which enables us to create relationships with our clients. We don't just stick people in a family of funds and tell people to check on their statements when they have a chance. We have recurring meetings with them and get to know them. And like you said, Jonathan, our front office staff watches the RMD list every year to ensure each of our clients takes their RMDs to prevent these IRS penalties. And that's a lot of money that's gone up in smoke for people.
For sure. And you know the government loves it.
Oh, they do.
They're sitting around going,
that's free money for them.
$1.7 billion extra dollars because people forgot to take their RMD.
Forgot to take it.
Whoops. All right. So should we ban social media? A recent U.S. survey found that 64% of participants favored banning social media for children under the age of 16. Count me in that list. While 35% opposed the measure. In addition to the social media ban, the survey asks participants about their views on banning cell phones in kindergarten through 12 classrooms. A staggering 69% supported the idea, count me in that list as well, while 31% opposed it. The release of the poll comes on the heels of Australia's landmark legislation, which took effect on December 10th. The new law, known as the Social Media Minimum Age Act, prohibits anyone under the age of 16 from holding a social media account, making it one of the strictest online safety rules in the world. The banned platforms in Australia include popular sites like Facebook, Instagram, TikTok, and YouTube. Australian Prime Minister Anthony Albanese made a last-ditch pitch to convince adolescents it was for their own good in the hours before the ban began. In the United States, lawmakers from both parties have been warning about the potential risks associated with social media use among children, with some calling for stronger age restrictions and tougher accountability rules for social media platforms. Recent studies have further highlighted the need for action on the issue. An April 2025 Pew Research Center report found that nearly half of American teenagers believe that social media has a mostly negative effect on people their age. Moreover, a 2023 Gallup survey revealed that 51% of U.S. teens spend at least 4 hours a day on social media.
That's a lot.
It is a lot.
And rising rates of poor mental health among our youth have been called a national crisis. A Pew survey of teens found that even the teens say that 48% of the time that social media harms people of their age. There are some positive aspects of such connectivity and network of friends, but there's also a dark side which we've all heard about. Dr. Linda Mays is the chair of the Child Study Center at Yale, and she says that the social media is facing issues similar to what we faced when television first came out. They both have pros and cons, she says, and the trick is to help parents navigate and filter out the parts that can be detrimental. The difference between TV's burgeoning days and social media is night and day, though. There's just about nothing that your child can't find, see, or read or be exposed to on social media today. It's a very scary place to let your kids roam free. I know with our granddaughter, we are all very careful about her access to social media and the games that she is allowed to use. And I think every parent needs to really investigate any site, platform, or game before allowing their child access.
100% agree.
All right. Life hack or AI hack. The secret phrases that get you past the robot customer service. If you've ever screamed human being or representative at your phone, this one is for you. And it's for me for sure. Say you're calling customer service because you need help. Maybe your bill is wrong, your service is down, or you want a refund. Instead of a person, a cheerful AI voice answers and drops you into an endless loop of menus and misunderstood prompts. Now what? So you want to talk to a human. For starters, don't explain your issue. That's the trap. You need words that AI has been programmed to treat differently. For example, when the AI bot asks why you're calling, I need to cancel my service or I'm returning a call, the word sets off alarms that often sends you straight to the customer service retention team. Saying you're returning a call that signals an existing issue the bot cannot track. When the system starts listing options, clearly say the word supervisor. If that word doesn't work, you can say, I need to file a formal complaint. Most systems are not programmed to deal with these complaints or supervisors. They escalate fast. And if you are asked to enter your account number, press the pound key instead of numbers. Many older systems that treat unexpected input as an error and default to a human. When AI bot asks a question, pause, wait 10 seconds before answering. These systems are built for fast, clean responses. Long pauses often break the flow and send your call to a human response. I think this was pretty interesting.
Yeah, I'm going to start trying to use some of these tricks.
Right.
Now, should you pay off your mortgage or invest? If you're among 85 million American individuals or families who own a home, you've probably asked yourself this question, and the answer depends on your mortgage rate, your investment timeline, and your personal comfort with risk. Let's break down the math and the factors that you should consider to help guide your decision. If at its core, this decision comes down to comparing two numbers, your mortgage rate, your mortgage interest rate versus your expected investment return. For many homeowners, particularly those locked in the low rates in 2022, investing the extra money makes more financial sense. Higher long-term returns. The S&P 500 has historically returned about 10% annually over long periods. Even being conservative and expecting 7 to 8%, that typically beats the mortgage rates of 5% or less. The key word here is long-term. You need to leave the money invested for at least 5 years, preferably much longer, to smooth out the inevitable ups and downs.
Yep. And here's the thing about your home's equity versus an investment account. With an investment account, your money remains accessible. Your home's equity is trapped. It's not easy to access. You need to sell your house, take out a home equity loan, or refinance it to tap into it. And taking out an equity loan or refinancing it will cost you money in the form of interest. Money in a brokerage account, well, you can sell whatever portion you need when you need it without cost unless you owe taxes on the gains. Tax advantages compound your returns. Contributing to a 401k reduces your taxable income, and you may get an employer match on top of that. A Roth IRA grows completely tax-free. Meanwhile, if you itemize deductions, you're getting a tax benefit from your mortgage interest. But paying off the mortgage eliminates that deduction.
The math doesn't always tell the whole story. There are legitimate reasons to prioritize your mortgage. Guaranteed return, zero risk. Paying off a 6% mortgage is the equivalent of earning a guaranteed 6% return. The stock market offers no such guarantees. If you're planning to cash out investments within 5 years, you're taking a real gamble. Markets can drop 20% or more in any given year. Peace of mind does have value. There are times in personal finance where the mathematically optimal choice isn't the right one. Some people sleep much better without a mortgage payment hanging over their head. Owning your home outright provides security that doesn't show up on a spreadsheet. That psychological benefit is very real. You're close to retirement. Traditional wisdom says to pay off your mortgage before you retire, and there's a good reason for that. Living on a fixed income while carrying a large mortgage can feel very precarious, especially during inflationary periods when your dollars buy less but your payment stays the same. The landscape looks different depending on when you got your mortgage. If you bought or refinanced between 2020 and early 2022, you probably locked in a rate below 4% and some below 3%. With rates like that, even a basic high-yield savings account can out-earn your mortgage. If you've bought more recently at a rate of 6 to 7%, the decision gets a little tighter. You need more substantial investment returns to justify keeping the mortgage, and the margin for error shrinks.
Before you put extra money toward either your mortgage or investments, make sure you've covered these basics. Building an emergency fund. You need 3 to 6 months of expenses saved and easily accessible. You don't want to turn to credit cards for unexpected costs because all your money is tied up in your house or locked in retirement accounts subject to early withdrawal penalties. Second, capitalize on a 401k match. If your employer matches your 401k contributions, grab that free money first. That's an instant 50 to 100% return on your contributions, beating any other option. Third, eliminate high interest debt. Credit cards charging 20% or more should be paid off before you accelerate your mortgage payments or invest extra in taxable accounts.
If you're still unsure, walk through these questions. How long until you retire? And when will you pay off a mortgage if you stick to minimum payments? If your mortgage will be paid off well before you stop working, there's less urgency to pay it off sooner. 2, how long can you stay invested before you need the money? If you might need the funds within a few years, the certainty of paying down your mortgage likely beats the market's volatility. 3, how would you feel if the market dropped 30% the year after you chose investing over paying off your mortgage? If that scenario keeps you up at night, the right answer might be the one that lets you sleep. Here's the final thoughts on this. For most people with mortgage rates below 5% and a decade or more until retirement, the math favors investing. For those with higher rates, shorter time horizons, or a strong preference for certainty, paying down the mortgage often wins or comes very close.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
Okay, all that glitters is gold when it comes to charitable donations. Little pun in that title there. Donating a highly appreciated asset allows you to reduce taxable gains and do good at the same time. And few things have appreciated quite like gold, which was up 53% in 2025. If you sold gold purchased in the past, you would owe capital gains taxes on that gain. But if you donate that same gold to a qualified nonprofit, you'll pay no taxes and you'll get the tax deduction on the full value of the gold. Donations of gold are rising. Anonymous gift givers dropped 8 gold coins of various sizes in the Salvation Army's red kettles around Thanksgiving in Chicago. These coins will likely be worth more than $10,000, according to the organization. Precious metals are a particularly good choice to gift because the long-term capital gains rates for gold and other precious metals are higher than for stocks and other securities. The Internal Revenue Service considers precious metals collectibles and taxes the long-term capital gains at up to 28%, which is above the highest 20% long-term capital gains rate for stocks and bonds. That higher tax rate affects both physical coins and bars and physical-backed exchange-traded funds. Short-term gains are taxed at the donor's standard ordinary income tax rates.
Right. So how do you donate gold? So if you own gold ETFs and your designated charities can accept securities, the transaction is the same as if you donate your stock since it is a transfer between two custodians. Perhaps you bought physical coins and bars at Costco or inherited gold and are feeling generous. It will take a few steps to ensure the process goes smoothly and that your gift does meet the IRS rules. You may need to get your metals appraised before donating, though. The IRS requires a qualified appraisal from a certified metals appraiser or a gold dealer for any non-cash property donations over $5,000. If your donation is over $500, you will need to fill out an IRS Form 8283 for non-cash charitable contributions. If the gift is over $5,000 and you're giving physical gold, the appraiser and the charity must also sign the form. Donors who are looking to unload broken jewelry or grandma's old sterling silver tea set to take advantage of the high precious metal prices have an option as well. Several charities, including the Alzheimer's Association and the Hospice Foundation of America, work with Jewelry for Good, which accepts certain scrap metals and works with refiners who melt down the pieces. The donation will reflect the total gram weight of the metal after processing.
Now on to cars. Car payments now average more than $750 a month, entering the 100-month car loan, or 8.88 and a third.
You can put this in the category with 50-year mortgages.
Yes.
Yeah, 8.33 years. That's crazy.
The price of a new car and trucks in the U.S. has increased 33% since 2020, and consumers are piling on interest as they stretch out long-term loans to 8, 9, and even 10 years. We don't have $300 monthly payments any longer in new vehicles. It's a thing of the past. The average price of a new car broke the $50,000 barrier this fall, according to Kelley Blue Book. This is up from the much less $38,000 in 2020 before the pandemic hit. As sticker prices marched higher, so did monthly payments. For a few years, car shoppers were undeterred. Many needed new vehicles after putting off buying during COVID when supply chains were unpended and dealers' lots were empty. Others, feeling flush, opted for luxury vehicles at much higher price points.
Yep. Fast forward to November of this year, and the average monthly payment for a new car was estimated to be $760, according to J.D. Powers, which is an industry research firm. The hefty cumulative inflation is starting to weigh on customers, and now some Americans are falling behind on their car payments. In the third quarter, a third of all buyers took out loans that stretched at least 6 years or 72 months, according to Experian. A year ago, 29% of buyers did so. The volume of loans with 85 to 96 months to repay, or up to 8 years, rose as well. Some loans now reach 100 months or more than 8 years, especially for the purchase of larger pickups. One problem is that automakers aren't making models with sticker prices under $30,000, which in theory should represent a real opportunity for the car companies. The reliance on longer car loans illustrates how Americans are taking on and holding on to greater debt loads for longer periods. In the third quarter, Americans carried $1.6 trillion in auto loans, up $300 billion compared with 5 years ago. The White House is starting to stress the need for new cars to get cheaper. President Trump recently directed federal regulators to pave the path for automakers who want to sell tiny, more affordable cars in the United States that don't currently meet government safety standards. There are signs that consumers would jump at the chance to buy them. Ford said earlier this month that consumers have been gravitating towards cheaper base packages for most of their popular models. Sales of Ford's entry-level Maverick pickup truck jumped 76% in November, according to the automaker's data.
That's encouraging to me.
It is.
At Jeep, where sales plummeted during the pandemic, in part because of high pricing, lowering prices by thousands of dollars on many vehicles is allowing it to target a wider range of customers. A significant portion of Jeep's portfolio now falls below the $50,000 sticker price that we just talked about, and that helped boost sales by 11% in the most recent quarter. Some industry executives have justified longer loan terms because vehicles tend to stay on the road longer, thanks to improvements in technology and engineering. What is different now is the rapid rise in the sticker price itself. Customers are borrowing more to cover car costs, with the average new loan exceeding $42,000 this past year. When consumers are deciding what loan term makes the most sense for them, it's important to consider the total cost of car ownership, not just the price of the car at purchase. For example, a $50,000 car loan at 5% over 5 years works out to roughly $950 a month and $6,600 in total interest paid. At 100 months, the monthly payment would drop to about $600, but the borrower would pay more than $11,000 in interest.
Yep, that's just terrible. I recently saw an article about two auto companies. One was Slate and the other one was Toyota, and they were building pickup trucks that had no automatic anything, and they are selling for about $25,000 to $28,000. So I looked up the Toyota, and they're selling the truck, but it's only overseas, and there's hardly any markup, so it's not very profitable for them. But the Slate truck is selling in the United States, and you can reserve one online for $50.
Slate is the brand?
It's the brand, and it's Slate because it's a blank slate. So when you go online, that's the theory behind it. It's a blank slate. You go online, and you don't pick a paint color. You pick a wrap color.
Oh.
So I mean, so your colors are endless, and it's not a super ugly truck, but it's not a super sexy truck either.
Right.
You know? But it's very utilitarian. Crank windows. It doesn't come with a stereo system.
No stereo at all.
It's set up so that you can put in a
Bluetooth speaker.
Bluetooth speaker and everything. So it's.
I like it.
I do too.
So Slate is a new company?
It
or
is.
Okay.
It is. And so it's not. You should look it up. Just look up
I am
Slate.com. So they started out saying it was going to be a $15,000 truck, but now it's up to like 20, 25.
I'm sure.
So-
I'm sure it's harder to meet $15,000 than we would think.
Yeah, but $100,000 for some of these cars, and for 10 years, that car is not going to be worth anything by the time it gets to 10 years.
For
You're
sure.
still going to be making payments. It's just terrible.
Right.
So
Again, put it in the category with the 50-year
you know,
mortgages.
everyone should be looking at off lease. Let somebody else take the depreciation hit. Go buy a car that's 3 years old that's coming off of a lease.
Yeah.
Right.
Agreed. All right. The fight over making data centers power down to avoid blackouts. Power-hungry data centers risk pushing parts of the U.S. power grid toward failure. Some technology companies are fighting a potential solution: disconnecting the data centers from the grid when electricity is in short supply. Across the U.S., tensions are mounting as companies including Google, Amazon, and Microsoft debate with utility executives whether their electricity needs to be met without causing blackouts during times of extreme demand. Power officials have been raising concerns that the grid isn't equipped to handle the sheer number of data centers that tech companies are seeking to build. They say it will take many years to build new transmission lines and power plants needed to support the surge in demand while keeping the lights on for other customers. Meanwhile, they're working to find ways to connect data centers to the grid sooner without jeopardizing the reliability of the system. Some have proposed either requiring or encouraging data centers to stop using it when there's a risk of blackouts, either by powering down or switching to backup electricity supplies. Michael Weber, an engineering professor at the University of Texas at Austin and former chief technology officer at investment firm Energy Impact Partners, he says it's a high-stakes fight because hundreds of billions of dollars or trillions of dollars of capital are on the line, and power is the critical bottleneck. The problem is most acute with PJM Interconnection, the organization responsible for overseeing a power market spanning 13 states in the Midwest and Mid-Atlantic region. A surge in data center development there already has pushed electricity prices higher and made the threat of blackouts more likely. PJM executives spent months last year trying to negotiate solutions with tech companies and others involved in the build-out. PJM proposed, in part, having data centers bring their own power source or otherwise agree to have service cut off when supplies get too tight.
The Data Center Coalition, a trade group, and some of its most prominent members called the proposal discriminatory and expressed concern about the potential need to rely more heavily on diesel backup generators, which are subject to air quality regulations and other restrictions. They argue that data centers need to run constantly, not only to train and run AI models, but also to serve cloud computer needs for other sectors, including healthcare and financial services. They contend that a reliable power grid is essential for data centers, which depend on consistent, uninterrupted power to support critical operations. PJM has planned to wrap up new rules for data center connections by the end of last year, but the process ended in a stalemate in November when its members, which include utilities, power plant owners, and customers, including tech companies, failed to agree on a plan.
Yep. In December, a meeting convened by Virginia utility regulators with an energy policy manager for Amazon Web Services. Amazon said that the company had concerns about any proposal that would require data centers to be disconnected to be disconnected from the grid for more than brief periods. The company's data centers have backup diesel generators, but they're only designed for limited emergency circumstances. Amazon said they have an obligation to customers that are operating in times of peak energy demand, right during these times of emergency, whether it's first responders or air traffic controllers that continue operating despite an emergency call. They have to be available to those customers, and I get that. In Texas, which has become a hotspot for data center development, peak demand is expected to nearly double by 2035 to the state's grid operator, first known as ERCOT. By then, Texas utilities expect data centers to remain more than 86 gigawatts of power, to require more than 86 gigawatts of power, which is roughly the record amount of electricity Texans used on a sweltering day in August of 2023. Texas lawmakers last year passed legislation establishing conditions for cutting off data centers from the grid when power demand threatens to exceed supply, and Republican Greg Abbott has already signed the bill.
The Southwest Power Pool, SPP, which operates part of the grid stretching from Texas Panhandle to North Dakota, has been working to establish new rules for data centers looking to tie into the system. It plans to begin offering data center operations the option of conditional service, allowing them to connect to the grid faster with the understanding that they might get cut off when supplies tighten. Some may want to do that, others may not, says SPP's chief operating officer. SPP's goal is to provide them with the option while at the same time maintaining reliability.
Google's one of the few tech companies that for years has been working to determine how it can change its machine learning processes to use less power during times of strain on the grid. The company has pilot programs with several utilities in which it reduces power use within its data centers in exchange for payment, a tactic known as demand response. With lengthening wait times to connect to the grid, data center operators that figure out how to reduce power consumption when needed might be able to get ahead in line, according to Jesse Jenkins, who heads Princeton's Zero Carbon Energy Systems Research and Optimization Laboratory, also known as ZERO. A study published last month by ZERO and 2 energy software firms found that data centers that build their own power sources and agree to disconnection during times of strain might be able to connect to the grid 3 to 5 years faster than those that don't. The research was funded by Google. The pressures of connecting to the grid at the scale and pace that people are talking about is going to push these solutions. According to Jenkins, there is not another option.
You know, the small-scale nuclear facilities that we were talking about a few months ago on the show, that's got to be the answer to this. I mean, because, the grid can't continue to support this.
Right. Not under the current infrastructure.
Yep.
I know. It's grown too fast.
It has.
Data center markets will expand 14% in 2026, according to reports. The data center market is poised for another year of significant growth that will lift all the industry's myriad players, according to a new report from the real estate firm JLL. On the tech side of the business, AI hyperscalers and data center operators will race to build the computing capacity needed for the artificial intelligence boom, JLL contends. Meanwhile, landlords and energy companies will find their services in high demand as AI developers search for places to build data centers along with enough power to keep them running. The majority of data center tenants are hyperscalers and Fortune 500 firms that have strong business cases and operations, according to JLL head of data center research, Andrew Batson. They're well-funded firms, so we don't subscribe to the bubble commentary, according to Batson.
And the global data center market is expected to grow at about a 14% a year rate between 2026 and 2030, according to JLL's report. Over that time, 100 gigawatts of data centers will be built, doubling the world's capacity. The best-case scenario would mean that a 20% annualized growth, and a worst-case scenario, even if a pullback in AI spending, worsening geopolitical conditions and a struggling economy, would have the current estimate to about 7% growth, according to JLL. That range illustrated how bullish the outlook is. Even with the downside scenarios, there's still some growth in the sector, and a 7% growth would still be very, very respectable.
For the 2025 tech winners, semiconductors used in data centers will grow from 20% of the market currently to 50% by 2030, according to JLL estimates. That growth will make semiconductor sales to the data centers a $180 billion market. Among the AI industry's usual suspects were chip makers like NVIDIA, TSMC, and Micron Technology. NVIDIA's gains roughly doubled last year's S&P 500 rally, rallying 39%. TSMC topped its rival NVIDIA, which with more than 50% increase. Micron was one of the top performers in the S&P 500, advancing about 240%. It is already having a strong 2026, up close to 10% year-to-date through Monday. The memory chip companies SanDisk and Western Digital, which split from each other in February, led the S&P 500 in 2025 with 560% and 282% increases. Other equipment providers like Celestia and Ciena that provide things like data storage hardware and fiber optic cables also had a standout year.
The hyperscalers need cloud providers. In addition to all the hardware and chip companies, cloud providers also make up a critical part of the tech infrastructure. These companies provide the services that connect AI systems to the individual consumers using them in their daily lives. Last year, cloud companies CoreWeave and Cloudflare both rose about 80%. The exact nature of how AI companies will use data centers is set to change in the coming years. By 2027, inference, the computing functions that actually spit out the AI-generated results, will overtake the training of those models within data center workloads, according to JLL. As a result, AI developers will be looking to spread out their data center facilities so they provide greater coverage to users across the country. CoreWeave, in particular, is well positioned to connect data centers that get built far away from each other, according to JLL. Alphabet, or Google, which doubles as both a cloud provider and a hyperscaler, led the Mag 7 in 2025 with about a 60% gain. The biggest hyperscalers, including Alphabet, again Google, Meta, which is Facebook, and Amazon, will continue the trend of both leasing space in third-party data centers and building out their own data centers. Through 2030, hyperscalers will build about 41 gigawatts of capacity in data centers that they own, which would double the size of their proprietary facilities to 70 gigawatts per JLL.
Where there's power, there are data centers. As tech companies race to build out the data centers needed to run AI systems, they also need huge amounts of power to keep them operating. So much so that the availability of power rather than location or cost has become the principal factor used for setting a site, according to Batson. Really, wherever hyperscalers or developers can find significant power, they're putting up data centers, Batson said. To ease the burden on power grids, some jurisdictions are considering so-called bring your own power regulations. These policies require data center operators and hyperscalers to either develop their own independent energy sources to power their new facilities or pay to upgrade the power grids. The governor of Virginia, Maryland, Pennsylvania, and New Jersey jointly proposed a law that would fast-track approvals for data center companies that agree to generate their own power.
I think that's a fantastic idea.
Yep.
I think that would kind of fix everything.
Yep.
The grid is operating so close to capacity that if you want into the party, you got to bring a party favor, Batson said. He gave the example of a data center in Michigan in which the developer, Related Digital, agreed to provide the regional utility company DTE Energy with a new battery storage facility to help with the increased workloads.
All right. The demand for power has pushed a series of both established and emerging energy companies to the fore of investment landscapes. Boom Energy, BE, an innovative battery company, saw its stock jump to close to 300% last year as sales boomed. In the third quarter, it reported a 57% increase in revenue. At the same time, legacy players like GE Verona and Constellation Energy also soared in 2025. GE Verona was up almost 100% and Constellation close to 60%. Even companies whose business lay outside energy have benefited. For example, Caterpillar, best known for bulldozers and tractors, led the Dow Jones last year on the back of soaring demand for its power generators. At least 3 analysts raised their price targets for Caterpillar this month, according to data from FactSet and LSEG. Shares are already up about 7% so far this year.
If I'm not mistaken, Caterpillar also pays a pretty handsome dividend
They
too,
do.
doesn't it?
It's a nice dividend.
So that it had that increase in its share price and it pays a nice
That's right.
dividend. Wow, what a company. All right, a land rush. Land on which to build data centers will also continue to be a very hot commodity, and we've talked about this before too. Rents for data centers in the Americas will grow 7% a year through 2030, according to JLL. Some major landowners have already entered into agreements with data center operators. For example, Texas Pacific Land TPL, one of the largest private landowners in Texas, signed a deal that will let the startup Bolt Data and Energy build data centers on its land. Shares of TPL jumped about 7.5% the day that this deal was announced. Many of the main AI hyperscalers also own large swaths of land, which they might eventually use for data centers. For close to a decade, the hyperscalers have been land banking across the U.S., and they have amassed tens of thousands of acres collectively, Batson said. They can sit on it, pay the property taxes for the dirt, and maybe do something with it in the future. It's kind of a low-risk investment for the future. Batson added that he expected to see more such land purchases over the course of this year.
Now for sweeping minimum wage hikes that are taking across the country. 19 states raised their minimum wage starting this month, providing a pay bump to an estimated 8.3 million workers. Workers in a mix of Democratic and Republican-controlled states will see higher hourly pay this year because of an automatic inflation-pegged adjustments, new laws, or ballot measures. 30 states have now set a higher minimum wage than the federal minimum wage of $7.25 an hour. On January 1st, Washington State adopted the highest state-level rate at $17.13 an hour, becoming the first state to enact an hourly wage above $17, the rate that some Democrats have been pushing to be adopted nationally. In Hawaii, baseline hourly rates rose by $2 to $16. That was the largest jump of any state in the country. In Nebraska and Missouri, voter-passed ballot initiatives brought those states' minimum wage to $15 an hour, more than twice as much as some neighbors that have maintained the federal minimum wage of $7.25.
For the first time, more workers now live in states that pay $15 or higher per hour than those who have kept the $7.25 minimum, according to an analysis by Economic Policy Institute, which estimates the number of workers affected by this year's increases. 2 states, Georgia and Wyoming, still have laws that mandate a $5.15 an hour minimum wage, though employers in those states covered by the federal labor laws have to pay at least $7.25 an hour based on the national baseline. The same is true for 5 other states, all in the South, that don't have minimum wage laws. The hikes come as voters grow more concerned about stubbornly high prices and the increased cost of living, and affordability emerges as a political issue likely to play a central role in the 2026 midterm elections. More than 2/3 of people polled by Reuters in October supported minimum wage increases, including 9 in 10 Democratic and nearly half of Republicans. Economists continue to debate the effects of raising the minimum wage. Some argue that setting the higher pay floor hurts businesses' bottom lines, leading to increased prices or lower employment. Others say it benefits workers and reduces poverty.
David Newmark, an economist professor at the University of California, Irvine, said that the businesses often have little maneuvering room on prices and few ways to offset the added labor costs that come with wage hikes. Partly for that reason, he said many studies show that higher minimum wages often result in fewer jobs. Other research has found no such fall in employment. Michael Reich, an economist at the University of California, Berkeley, and the chair of the Center of the Wage and Employment Dynamics, said price hikes aren't always large. However, they don't always have a broad effect on demand. He says that was true for California when they enacted a $20 minimum wage for fast food chains in 2024, when employer turnover actually decreased. In some places, localities have set minimum wages higher than those mandated through the rest of the state. Seattle's minimum wage increased to $21.30 on January 1st, among the highest of any city in the country. Beginning this year, workers in New York, Long Island, and New York's Westchester County will earn at least $17 an hour, higher than the $16 per hour minimum wage enacted by the rest of the state. And in Los Angeles, a law passed last May setting a minimum hourly wage of $30 for hotel and airport workers starting in 2028.
Randy, when you were a teenager and you started working, do you remember what you were making?
Oh, geez.
Wait, you talked about being a dishwasher or something.
Dishwasher and then a meat cutter.
Were you $4 an hour? What were you making?
Oh, my gosh. I don't think it was $4 an hour.
Okay.
I think it was like $2.85 or something like that.
25 years ago, I was 15 working in a construction job making $8 an hour. And as a 15-year-old, that was a lot of money.
Yeah.
So I don't know. There's got to be a happy medium.
Look, back then, all I cared about was having enough money to put gas in my Volkswagen.
For sure.
So anyway, everybody, thanks for being with us this weekend. It's great to be back, and we will look forward to seeing you next week.
Have a great weekend.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, please contact their office at 478-922-8100 to set up your complimentary consultation. You can learn more about them by visiting their website, retirerelax.com. And if you have a question or a topic that you would like them to cover in next week's broadcast, you can email Randy at rfmoney.com. They look forward to connecting with you next week. Have a great weekend, everyone. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.